Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to the bigger picture with me, Ryan Huang. And we've got a lot of talk about tariffs these days, sending markets back up, back down. It's quite a choppy trading environment. And in this case, we've got to figure out where to find safety when it comes to your investments. And helping us out this morning is Francis Tan. He is the Chief Strategist for Asia at Indosuez Wealth Management. Francis, good morning. How are you doing?
Good morning, Ryan. Everything's okay over here?
Yeah, looking pretty okay so far this morning, at least, because we've got a bit of a dialing back of trade tensions with what Donald Trump's administration is saying. They are sending a message that they are okay, inclined to reach a deal, because right now, where things are in terms of tariffs, it's not sustainable. What do you take away from the current signals that they are sending?
The current signal, I believe, is that they have finally assessed the implication and the ramifications of the trade tariff against many other countries, predominantly against China. In my own research, I found that if this were to continue, and if the national equilibrium of this game theory is going to continue, whereby both parties are very much attacking one another, the overall impact on the U.S. will be more severe than China. Now, the common investors' thinking is that, if the U.S. is going to increase tariff against the rest of the whole world, including islands with penguins on it, that will drive up inflation higher. But I will hesitate to think along this line of thought, because I would believe that the impact on growth, on overall GDP, will be much worse and more negative for the U.S. rather than inflation. I mean, giving an anecdote, if the next series of iPhones are going to be a lot more expensive due to the tariff, as a consumer, they may not just want to upgrade. They will say that, okay, maybe I will just hold on to the previous generation of iPhone. And by that happening, you are reducing the revenue of a particular company and that for the rest of the other companies as well. So for that, I believe the overall growth is going to be a lot more negative for U.S. And right now, I think what Dustin is saying is that the analysis from them in thinking that it's going to be so negative for growth will be really very much impactful on the U.S. economy.
Yeah, Francis, that's a great point. Despite what happens on the tariff front, you can't control what happens to sentiment, because you have people maybe tightening their purse strings, or even businesses just feeling more cautious because they don't know if there might be another flip-flop down the road, so they can't make plans. So to that degree, what is the growth forecast globally and for specifically China? Because the IMF has downgraded their forecast for China to 4%, which is a drop from the earlier forecast of 4.6%, also below Beijing's official target. So how much pain are we in for when it comes to the impact on the global economy? Are we still looking out for a recession?
Well, if the tariffs are going to continue, as what we have seen, and as I mentioned, it's going to drive up quite a bit of a consumption decline, that would mean that China may have also excess capacity. Because in the past, if you're going to send a lot of goods to the U.S., and because of that right now, you can't really send them, they may be stuck with quite high inventories. And overall, if they can't consume it domestically, they may also have to send it to the rest of the country. Of course, the good news is that we may get even cheaper goods from China.
Yeah.
That's one thing, because of the excess capacity. But nevertheless, tariffs are a tax on consumers at the end of the day, at the end of the entire value chain. What that means is also that because of the tax, consumers will have to give up expenditure on other things because of this tax. So what that means is, again, that it's going to be quite negative for growth, and that's exactly what we saw yesterday from the IMF, downgrading their forecast around the world, including us over in Indosuez. We have, in our most recent investment committee, downgraded our forecast for U.S. to only 1.5% this year, and that was down 40 basis points. For Eurozone, only 0.8%. China, I've downgraded it to 4.5%. Still optimistic if you compare it with that of the IMF. But that said, the direction is clear. Tariffs continuing on will mean a tax on consumers. Consumers going to substitute their demand away. And what that means is that we're going to see much slower growth in the whole world this year.
Yeah, talking about slower growth, we've been watching the earnings season to see if there are any signals on that front. And the latest off the blocks is Tesla. Their first quarter profits plunging 71% to $409 million. That misses analyst expectations. You have a 9% drop in revenue, and then the company citing changing political sentiment as a drag on demand, which suggests it could be tied to Elon Musk's involvement with the Trump administration. Now, what is your reading coming through from the earnings season as well as what's saying?
Right. For Tesla particularly, they have quite a couple of headwinds. Number one is his involvement, as you mentioned, in the DOGE. That's number one. And there's a lot of pushback by people because of his involvement there. Number two, in terms of competition, I recently just came back from Shanghai, and the competition from EVs or Chinese-made EVs is huge in terms of its quality, the pricing, the cost, and the quantity and the capacity. So on the revenue front, Tesla will have such challenges. Now, on the cost front, Tesla will also have some challenges. Although most of the Tesla that's sold over in the US is made onshore in the US. However, they do need to import many of the parts from China, and the tariff will mean that the cost is going to be much higher for Tesla importing such of the items from China, the parts. So I think that Tesla will have quite a bit of a profit margin squeeze as what we have seen also in the earnings season. But overall, right now, in terms of the US earnings season, I would say that those that rely a lot on imports from China, they could be impacted quite strongly. But those that are related more to the domestic consumption, the services sector, I think those are still a little bit more okay. But eventually, they are all going to be indirectly impacted by the just simply slower growth in the U.S.
Yeah, notwithstanding headlines, when you talk about China, I've been hearing how some folks have been quite optimistic, actually, because they are saying things have bottomed out, the worst is over, the worst has been priced in. When you were in China, do you see that in terms of consumer sentiment? What's your approach to approaching Chinese stocks right now?
Right. Of course, when I was there, I was in the main crowded area. So the crowded areas continue to be crowded. And that's only a small sample size of the entire nation. But looking at my dashboard of the indicators in China, things seems to be really bottoming out. And by the word things, it means the property sector. We do see some improvement in the property sector. And the property sector is a huge part in terms of the assets for the Chinese households. And once the government has got the political will to stem off any further decline in the property sector, that is the first step into improving sentiments. Right now, sentiments in China is still not boosting much higher, but I believe the bottom we have seen. And the recent equity actions, despite the drawdown when Trump announced a tariff, but now things are on the way up, I think this will be important for the sentiments over in China. So the wealth effect will be there from both the stock market and as well as the property market. Going forward, I believe the Chinese government is doing a lot to stimulate domestic consumption because they just want to buffer themselves away from the threats of tariff. And we have seen that the Ministry of Commerce in China, in fact, most recently issued a big plan. It's a 48-point plan boosting services consumption because at the end of the day, services are a lot more domestic. And services, even if you do exports, you are not tariffed. So that's, I think, one of the key strategies from the Chinese policymakers. Okay,
so not too pessimistic when it comes to China. So taking a step back, what is your broader approach towards markets? So where are the biggest conviction plays here?
Right, okay. Despite what the U.S. is doing right now on the tariff front, at the end of the day, we must know that a lot of the stocks, the equities listed in the U.S. space, are not simply reliant on U.S. economy. Although the IMF, including ourselves, has downgraded U.S. economic growth this year, but it doesn't mean stocks are impacted because many of these stocks, especially those in, let's say, in the S&P or even in the NASDAQ, they derive their revenue mostly from the rest of the world, not just from the U.S. So a lot of misconception from investors is, oh, yeah, U.S. economy is not doing well, let's pair off our U.S. stocks. Not true, because U.S. companies are global champions. They're not just a regional or domestic champion. So this is the key thing that I need to take note. So what that happens, but because of the slower global growth, we are likely to see stocks being in a much more volatile state this year because of tariff on and tariff off suddenly. We do want to pan out a little bit on our U.S. exposure, but that is still the largest part in our asset allocation. We would like to pump some of this into European stocks, particularly those in the more stable sectors. We do see some interesting opportunities in European real estate sector as well, because we believe the ECB is going to cut rates further. So some of these names in the real estate on the utility sector in Europe, we are increasing our allocation. Otherwise, right now in our neighborhood in Asia, I think Asia we can weather the tariff storm quite well. My own research shows that the OECD numbers that China's exposure to the U.S. final demand as a percentage of China's nominal GDP is only 2.8%, not as high, and it has come down over the many years. So China has decoupled away from the U.S., trying to set up their own exclusive economic club with the rest of the world except for the U.S. So I think it is quite important demand for China going forward.
Yeah, Francis, just to talk about allocation, right? We've been seeing gold prices on a bit of a tear. So is there leaning towards putting more money on that front?
Okay, of course, every day when I talk to investors, they are saying, should I buy more gold? But gold gets more expensive on a daily basis. If I look at purely at the technical analysis front, gold seems to be having a life of its own right now. And that's due to the extreme fear that we see in the world. And of course, again, once in a while, we have fear of de-dollarization, moving away from the US and things like that. But that, is a long-drawn situation. I mean, recently we have seen a lot of pumping into safe havens, gold, Swiss. We have seen the yen moving stronger. But to me, this is cyclical. Once sentiment settles now, once we have more voices like what Scott Besson talked about overnight, I think, or relaxing a little bit on the tariff front, gold may have a bit of a sell-off after that. And investors will slowly move away from the safe haven and back into risk assets again. So don't think that it's going to be one-line trend, that gold is going to go up forever. Just know that it's more tied to the global sentiment right now, which is still fearful, but I believe can relax a bit further.
All right. A reminder to stay diversified in the markets and to stay invested. We've been in conversation with Francis Tan. He's the Chief Strategist for Asia at Indosuez Wealth Management. Francis, always great chatting with you. Thank you so much for your time and insights.
Thank you for having me.
All right. Catch up again soon. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.